Hi, so welcome back to the second session. Here we're going to look at the solutions to the test that you took on the chapter Journals and Ledgers. Well, before we start reviewing the questions, I just like to tell you that this is a really important chapter and it would be good if you can spend adequate time on this chapter because this is where you get your basics double entry system right. And at the end of this chapter, you must be able to distinguish between an asset, a liability, a revenue, and an expense, and should be able to say or should be able to classify the accounts as personal accounts, real accounts, and nominal accounts, and also be able to pass journal entries. Right? That is, you must have clarity on which account to debit and which account to credit. Right? So let's look at the first question, which is accounts receivable account is A, an asset account, B, a liability account, C, a revenue account, D, an expenses account. See, accounts receivable account is an asset for the business. First, let's try to understand what an asset is. See, an asset is a resource which is controlled by an entity from which future economic benefits are expected to flow. Let's say a business has made a credit sale of 1,000 rupees, which means there is a receivable of 1,000 rupees in the books of the business. It's receivable from, say, X. So X is an account receivable for the business. So account receivable, in other words, is debtors. Right? So this, since you're going to get cash from this asset in future, it is, or you're going to get cash from this receivable or from this debtor in future, it is classified as an asset. Next is accounts payable account. Accounts payable is a liability. Now, what is the definition of a liability? A liability is a present obligation, the settlement of which will result in an outflow of economic benefits. So, an accounts payable is a liability because when we settle the accounts payable, there is going to be an outflow of cash. Suppose we buy goods from Y for 1,000 rupees on credit, then we get the goods immediately, but the payment is deferred depending upon the agreed credit period. So Y is an account payable to the business and the settlement of Y will entail an outflow of cash, and hence accounts payable is a liability. Question number 3, accrued interest account is a personal account, real account, nominal account, none of these. See, by this time you must be aware that all accounts can be classified broadly into 3 categories as personal accounts, real accounts, and nominal accounts. Right? Nominal accounts are accounts that record transactions relating to incomes and expenses. Real accounts are accounts that record transactions relating to our fixed assets and our intangible assets. And personal accounts are accounts that record transactions other than the transactions that are covered by real accounts and nominal accounts. See, accrued interest means interest is receivable to the business. Accrued interest is a personal account because it represents money that is to be received from a person. Right? So interest is a nominal account because interest is an income, but here interest is not received yet, right? And accrued interest is just accrued. So accrued interest account is a personal account because the account represents a person from whom interest is to be received. So to be very specific, it is a representative personal account. So answer is A. Next, adjusted purchases account. See, what do we mean by purchases and what do we mean by adjusted purchases? Purchases means all the goods that are purchased by a business for the purpose of either being traded or for the purpose of being consumed in the manufacturing process will be recorded in an account called the purchases account. So for example, if X manufactures furniture, wood that it buys will be debited to the purchases or will be recorded in the purchases account. Now adjusted purchases means purchases made during the year minus the closing stock of the goods that have not been used during the year. So that is the goods that are unsold or unused at the end of the year is called closing stock, and so purchases minus closing stock is called adjusted purchases. Adjusted purchases is an expense account. It is a nominal account and hence it appears in the trading account of the business while we calculate the gross profit. So the answer is D. Advance from a customer account is a personal account or a real account, or is it a nominal account? D, none of these. Advance from a customer means that is the business has received money from its customer even before it has made a sale. Right? So which means it is neither a real account nor a nominal account because it is not an income or an expense to be classified as a nominal account, nor is it a fixed asset to be classified as a real account. So it is a personal account because the advance received from a customer is representing the person from whom money has been received in advance. So answer is A. To be very specific, this is a representative personal account. Advance salary to Shyam account is natural personal account, artificial personal account, representative personal account, none of these. Advance salary to Shyam is even before Shyam has rendered his services to the business has paid him cash. It could be because there is a requirement, there is cash requirement for Shyam, and hence the business has given him salary in advance. Okay? So this advance salary account is a representative personal account. Advance to a supplier account. This is similar to advance received from a customer, but it's just that advance received from a customer is a liability, but advance made to a supplier is an asset because even before the purchase has been made, the cash has been paid to the supplier. So this is representing the supplier to whom money has been paid in advance, and hence it is a representative personal account. Advance to an employee account is, well, this is again similar to the advance salary that was paid to Shyam. Here again, an advance is paid to an employee before the employee has rendered his services. So it's an asset to the business, and it is a personal account because it represents the employee to whom the money has been advanced. Bad debts account. Bad debts is a loss to the business because it is the debt that has gone bad. That is, it is the debt which is irrecoverable. And what do we mean by debt here? Debt here means the debtors or the accounts receivable that have arisen due to the credit sales that the business has made. And bad debts means the debtors from whom money is receivable have gone bad or have become irrecoverable. It is a loss to the business and hence it is an expense account. Bad debts recovered account is a revenue account because a debt that had become bad has now been recovered. So it is a recovery of the loss and hence it is a revenue account. Next, bank deposit account. We might be tempted to say that bank deposit is real account. However, bank deposit is a personal account because the money that we have deposited with the bank is recorded in the bank column of the cash book, which we'll be looking at in our forthcoming chapters. It is recorded in the bank column of the cash book, or we maintain a separate account called bank account. We must realize that this bank account is nothing but an account that represents the bank in which we have deposited money or from which we are withdrawing money. So here it is a personal account. Personal need not necessarily mean a natural person. It can be an artificial legal person also. So bank being a company, it is an artificial legal person, and hence bank deposit account is a personal account. Bank interest charged account is, bank interest is an expense to the business, and hence it is written off against the revenue that the business makes during the year, and hence it is an expense account. Bills payable account. See, bills payable is nothing but, suppose X purchases goods on credit from Y, then X might accept a bill which is payable, a bill for 1000 rupees which is payable after 3 months. So this bill payable is a liability to X, and this bill payable account represents Y to whom money is payable by X. Hence, it is a personal account. The same logic applies here in case of a bills receivable account. If you take the same example, Y has sold to X on credit and he has accepted a bill from X, and so bills receivable becomes an asset to Y and it is a receivable from X. So bills receivable is an account that represents a receivable from X who is a person, and so bills receivable account is a personal account. Capital account. Capital account, capital means the amount of cash or contribution other than cash which is brought in by the proprietor into the business. Okay. So capital account represents the money that the proprietor has brought in. Hence it is representing the person, that is representing the proprietor. Hence capital account is a representative personal account. Cash account is an asset, definitely. It's the cash account is the cash that you have at hand and the cash that is there in the bank. And also cash includes highly liquid investments, that is investments that have a maturity of less than 3 months. That is also included in the definition of cash, and cash is an asset. Cash embezzlement account. Cash embezzlement means cash that has been stolen. Embezzle means stolen. Cash that has been stolen. So when an asset reduces, it is a loss. For example, when debtors go bad, we record bad debts, which is a loss to the business. Similarly, cash which is stolen is a loss to the business, and hence it is an expense account. Next we come to copyright account. Copyright is an intangible asset. For example, music companies have copyrights. So publishing companies have copyrights. So these copyrights are intangible assets, and hence copyright account is an asset account. Creditor's account is a personal account because a creditor is a person to whom the business owes money, and hence the creditor's account records all the transactions which involve credit transactions and settlement of the creditors, and hence it is a personal account. Debtor's account is a person, a debtor is a person who owes money to the business. That is, if X sells goods on credit to Y, then money is receivable to X from Y, and Y becomes a debtor to X. And hence, the account that records all the transactions of the business with Y is a personal account. Discount allowed account. Well, this happens when debtors settle their dues promptly. Suppose X is selling goods to Y for 10,000 rupees, and X says that if the amount, and let's say the normal credit period is 1 month, but X says that if Y is able to settle him within 20 days, then a discount of 10% would be allowed. So this discount is called a cash discount, and it is a loss to the it's a loss to the business that's allowing the discount. So if Y is settling X within 20 days, then X will have to give a cash discount of 10% on that 10,000, and hence he would receive 9,000 rupees from Y, and this 1,000 rupees would be a loss to X, and after this transaction there would be nothing that is due to X from Y. So discount allowed account is an expense to X. Discount received, right? So if we look at the same example, for Y, the 1,000 rupees that he receives is an income for him. He doesn't have to pay the 10,000. He has to pay only 9,000 because he's settling it before the normally accepted credit period. And so the 1,000 rupees that he receives as a settlement discount is a revenue account for him. Donation and charity account is an expense account. Businesses make donations to temples or donations to non-profit organizations, and so such expenses are a charge against the income for the year, and hence it is an expense account. Drawings account. Drawings account, I'm sure all of us would be tempted to say it is a nominal account. Drawings means drawings of either cash or goods by the proprietor for his personal use. That is, drawings of business cash or drawings of goods that have been purchased for the business by the proprietor for his personal use. So drawings account is the amount which has been withdrawn by the proprietor, which means that this account is representing the proprietor, and hence drawings account is a representative personal account. Just as we saw that the capital account represents the proprietor, the capital account shows how much money the proprietor has brought in. Similarly, drawings account shows how much money the proprietor has withdrawn, or how much goods the proprietor has withdrawn from the business for his personal use. Hence, drawings account is a personal account. To be specific, it is a representative personal account. Free samples account, again, free samples account is a kind of a selling expense, or we can say it is a kind of an advertisement expense. So that is, for example, we get some free sample packets of oats, or we get free samples of shampoos or conditioners. So all that is an expense to the business. Next question, question number 26. Goods costing 1,000 rupees, having a sale price of 1,200 rupees, used in making furniture should be, okay, right. So goods costing 1,000 rupees, having a sale price of 1,200 rupees, have been used in making furniture. So how should it be used? How should it be accounted for? Right. So it's evident from the question that the business is engaged in the business, or the sole proprietor, or whatever entity it is engaged in the business of making furniture, and it has bought goods costing 1,000 rupees, and it has used it in making furniture. So a little while ago we saw what is the definition, or what is the understanding of the term purchases. What should be accounted for in the purchases account? So goods that are either used in the manufacturing, or goods that are purchased for the purpose of resale, have to be shown in as purchases. So here so it's clear that we have to record this transaction in the purchases account. Next we come to what is the value at which this purchases has to be recorded. Is it 1000 rupees or the sale price of 1200 rupees? So purchases, you have purchased for 1000 rupees. That is the cost that you have incurred in buying the goods. So the cost that is incurred to buy the goods is 1000 rupees, and hence your purchase account should be recorded with this purchase at 1000 rupees and not at 1200 rupees. Next, goods destroyed by fire. See, again, this is similar. The logic is similar. There is a loss of an asset. Loss of asset means stock is destroyed. And so when an asset reduces, it is a loss. The same logic as we saw when we wrote off bad debts, when cash was stolen. Similarly, goods are destroyed by fire, and hence the value of the goods destroyed by fire is an expense, or it's a loss to the business. Next question is goods misappropriated by an employee. Misappropriated means stolen. Again, it is a loss to the business because the purchases or the goods that were purchased for the purpose of either being consumed in the manufacturing process or purchased for the purpose of resale have been misappropriated by an employee. So again, it is a loss of stock, and a reduction in an asset is always an expense. So, or the loss of an asset is an expense, and hence the answer is D. It is an expense. Right. Now question number 29. Goods sold to Ram for cash, rupees 1000. So how is this to be accounted for? Right. So we know that according to the dual aspect concept, or the double entry system of accounting, every economic transaction or every financial transaction in a business has two aspects to it, a debit aspect and a credit aspect, and the double entry system of accounting records both the aspects of a transaction. So this transaction involves cash coming in because of a cash sale for Ram, and goods are going out, which means a sale is being made. So cash comes in and sales are being made. So the accounting entry is, we know that cash is a real account, and the rule for real accounts is debit what comes in, right? So cash comes in, and so we debit cash. So cash account debit, and it is sales. Sales is an income, and incomes are nominal accounts, and the rule for nominal accounts is credit all incomes and gains and debit all expenses and losses. So we have to credit sales. So the accounting entry to record this transaction is cash account debit to sales. So none of the options given to us is correct except D, which is none of these. So answer is D. Next, goodwill account. See, goodwill is an intangible asset. Goodwill is an intangible asset that measures the reputation of a business. The reputation could be because of its customer lists, because of its promptness, or it could be because of the good pedigree that it enjoys. So a goodwill account is definitely an asset to the business. So it is an intangible asset, to be specific. Yeah, ICICI Bank account is a personal account, as we saw earlier, because the account in which we are recording all our bank transactions represents ICICI Bank. So it is a representative personal account. Interest receivable account. Interest receivable account is an account that represents a person from whom interest is receivable. Suppose X has lent money to Y, and Y has to pay interest on that money that he has borrowed from X, and some interest is due from X to Y, then the amount that appears in the interest receivable account represents the amount that Y owes X, and so it is a personal transaction. Sorry, it's a personal account. Interest receivable from Mohan, a borrower account is, okay. Interest is receivable means money has to be received from Mohan. So any account that shows or any account that represents money or any future economic benefit that is to be or that is supposed to flow to the business, then that account represents an asset account. Here, the business has lent money to Mohan, who is the borrower, and Mohan has to pay interest to the business, which means the loan that the business has given is first of all an asset to the business because of the loan that it has given, it is going to earn interest. And this interest is still due to the business from Mohan, and hence the account that records the interest that is receivable from Mohan to the business is an asset account. Right. The question should be interest received in advance from Mohan, a borrower. Okay, so it is interest that is received in advance. So here Mohan has borrowed money from the business, and the business has received the interest from Mohan in advance. It is even before the interest was due to the business from Mohan. So since it has received the interest in advance even before it is due, it is a liability. It is a liability. Interest received. Interest received is an income, and all incomes and expenses are accounted for in nominal accounts. Right? So interest received is a nominal account. Interest received in advance is right. So just two problems back, we saw that the business had received interest in advance from Mohan. So the account that records for the interest that the business has received in advance is the account that represents Mohan. That is, it represents the amount that the business has received in advance from Mohan, and hence it is a representative personal account. Investments in shares of ICICI Bank account is an asset account because an investment is made with the view of earning dividend, or it is made for the purpose of capital appreciation. For example, let us say that today the shares of ICICI Bank are quoted at 1000 rupees in the market. 1 month later, the shares of ICICI Bank are quoted at 1200 per share in the stock exchange. Which means, suppose you bought it at 1000 rupees, you can make a profit of 200 rupees minus the brokerage if you sell the shares after 1 month. So, an investment in shares is made either with the purpose of earning dividend or for the purpose of capital appreciation. So, it qualifies as an asset because a future economic benefit is expected from such an investment. Loan from Mahesh. Loan from Mahesh. Whenever we take loans from others, whenever a business takes a loan from a bank or from other lenders, then it is a liability to the business because the moment it takes a loan, there is an obligation to repay the loan, and the obligation is going to entail an outflow of cash or an outflow of kind also. So it is a liability. So whenever a loan is taken from another party, it becomes a liability to the person who is borrowing the loan. But suppose a loan is given to someone, then it becomes an asset because when you give a loan, it is going to fetch you interest, and hence there is going to be inflow of future economic benefits. So it will meet the definition of an asset. That's when we give a loan. But when we take a loan, it is a liability because we have to first of all service the loan and also repay the loan. Yeah, so loan to Ramesh. Suppose the business has given a loan to Ramesh, then that is an asset account because Ramesh has to pay interest on the loan that he has taken and he will repay the loan eventually, which means there is going to be an inflow of future economic benefits to the business that has lent the money, and hence it is an asset. Next, Messrs. Ram and Sons account is an artificial personal account. It is a personal account. Personal account can be further classified as natural personal account, artificial personal account, or representative personal account. Suppose a business has sold goods to Ram, right? Then Ram is a natural person. But here it is Messrs. Ram and Sons. It can be an association of persons, or it can be a partnership firm, right? So it is an artificial person. So it is an artificial personal account. Representative personal accounts examples are capital account, drawings account, accrued interest, interest paid in advance. All these accounts are examples of representative personal accounts. Messrs. Ram and Sons Limited. Yeah. So this is a company, and the companies are artificial. It's an artificial legal person, and so this is an artificial personal account. Yeah. Next, we come to question number 42. Normally, the following accounts are balanced. Right. So we saw that broadly there are three types of accounts: personal accounts, nominal accounts, and real accounts. So nominal accounts are accounts that record all transactions that are relating to incomes and gains, expenses and losses. So accounts like sales, interest received, dividend received, and all the expenses like salary, rent, insurance, depreciation. These are all examples of nominal accounts. So these are the accounts whose balances appear in the profit and loss account and in the trading account. While if we look at accounts like personal accounts and real accounts, personal accounts are accounts like the capital account, the drawings account, then accrued interest account, interest received in advance, or you have the debtors account, the creditors account. These are all examples of personal accounts. Now, if you look at real accounts, you have all the fixed assets, the intangible assets, cash, right? So these are all real accounts. And if you notice that the balances in the real accounts and the personal accounts are those that appear in our balance sheet. So the understanding is that normally the accounts that are balanced and the balances of the accounts that appear in the balance sheet and are carried forward to the next year as the opening balances are the real accounts and the personal accounts. Nominal accounts are generally not balanced. Now the balance in the nominal accounts are taken or transferred to the trading account and the P&L account. So the answer is C. Only personal accounts and real accounts are balanced. Next. On purchase of a machine, rupees 100 paid to workers as wages for installing the machine. Okay. So how is this going to be treated? See, when a machine is purchased, cash goes out, an asset comes in. Machine is a real account, so the rule is debit what comes in. Cash goes out, cash is also a real account, so the rule is credit what goes out. So the accounting entry is machinery account debit to cash. But here 100 rupees has been paid to workers as wages for installing the machine. Generally, wages is a nominal account and we debit the wages account. But here, the wages have been paid for installing the machine, without which, unless the machine is installed, it cannot be put to use. So since these wages have been paid in order to get the machine ready for its intended use, this 100 is to be added to the cost of the machine. Hence, the account that will be debited is the machinery account. Suppose the business had bought a machine for 10,000 rupees and it has incurred 100 rupees to install the machine, then the machinery account will be debited with 10,100 rupees and cash will be credited with 10,100 rupees. So here the answer is C. On purchase of an old machine, the machine was repaired at a cost of 1,000 rupees. Again, see here an old machine or a second-hand machine has been purchased, and in order to make the machine ready for use, some expenses have been incurred. That is 1,000 rupees has been incurred in order to get it ready for use. Hence, it would be wrong to charge off this as an expense, because without this expense, the machine cannot be put to its intended use. So, we have to debit machinery with 1,000 rupees, and cash is going out. So, credit what goes out, because cash is a real account, and so the entry will be machinery account debit 1,000 rupees to cash. Okay. Next, on purchase of goods of the list price of rupees 10,000 from Ram, who allowed 10% discount and 5% cash discount for immediate payment. So this is where we have to understand, or we should have clarity between, or we should have clarity in understanding the terms trade discount and cash discount. See, list price of 10,000 rupees means 10,000, that is the price that appears on the tag or on the catalog, is called the list price. Okay, you must remember that this list price is to be used only to calculate the trade discount. Trade discount is a discount which the supplier extends to the purchaser, either because he makes a bulk purchase or because of his long-standing relationship with him. The next thing that we have to remember with respect to trade discount is that no account is opened in the books to record trade discount. Here, goods having a list price of 10,000 rupees are purchased, and we get a discount, a trade discount of 10%, which means the business has actually paid 9,000 rupees. That is 10,000 rupees minus 10% of 10,000, which is 1,000 rupees. So the business gets a trade discount of 1,000 rupees. Sorry, and it pays 9,000 rupees to purchase goods. So the cost of purchases for the business is 9,000 rupees, right? But here we must understand that immediately he is getting a 5% cash discount for, because he is making a payment immediately, he is getting a 5% cash discount. Okay. So when you receive a cash discount, that cash discount is an income. So on a cost of purchase of 9,000 rupees, you are getting a 5% cash discount, and hence your net cash outflow is only 8,550. See, let's do a small calculation to understand this. See, 10,000 rupees is the list price, minus 1,000 rupees is 9,000 rupees. That is the purchase price. Okay, so you have to debit your purchases account with 9,000 rupees. And it is not a credit purchase because he is immediately settling the purchase for cash, which gives him an additional 5% discount. So on 9,000 he gets 5% discount, which is 450 rupees. This is the discount that he is receiving, right? So the cash outflow in this transaction is 9,000 minus 450, which is 8,550. The accounting entry for this transaction is purchases is a nominal account, it is an expense, and hence has to be debited. It has to be debited with the cost of purchases, which is 9,000 rupees. Okay, so purchases account debit 9,000. What is going out? Cash is going out. How much cash is going out? 8,550. So we credit cash 8,550, and we are receiving discount, which is again an income, we have to credit all incomes, and so we will credit discount received with 450. So the total of the debits matches the total of the credits. Answer to this question is D. Right. Question number 46. On purchase of goods of the list price of 10,000 rupees from Ram, who allowed 10% trade discount and charged 10% VAT, purchases account is to be debited with what amount? Okay, so here the list price is 10,000 rupees. So we apply 10% on the list price and we get 1,000 rupees as a trade discount, which means the cost of purchases is 9,000 rupees, on which a value added tax of 10% is added. Okay? So 10% of 9,000 is 900, and so the total cost of our purchases is 9,000, which is the basic cost, plus the VAT, which is 900, and so the total cost is 9,900 rupees. Okay. 47. On receipt of 975 rupees from Shyam in full settlement of his account for 1,000 rupees, Shyam's account should be credited with what? So we have to read the question very carefully here, because it says the business has received 975 rupees from Shyam in full settlement, which means nothing is due from Shyam. Before this receipt was made, Shyam's account showed a receivable of 1,000 rupees. On settlement, he has been given a discount of 25 rupees, and hence Shyam has paid only 975 rupees. But the business cannot go back to Shyam and say that 25 rupees is due from you, because this 975 was collected from Shyam in full settlement of his account. And so when a personal account, so the balance in a personal account is reducing, and the rule is credit the giver. In case of personal accounts, the rule is credit the giver. The giver is Shyam, so he has to be credited with 1,000 rupees. So the accounting entry for this transaction will be cash comes in. So debit what comes in, because cash is a real asset, a real account. So cash account debit 975. You are extending a discount to 25 rupees, which is a loss for you. All losses are nominal accounts. Rule for nominal account is debit all expenses and losses, and hence you will debit 25 rupees and you will credit the giver. So Shyam is the giver and he'll be credited with 1,000 rupees. So his account is closed. Right. Question number 48. On receipt of 975 rupees from Shyam on his account for 1,000 rupees, Shyam's account should be credited with what? So see, this is slightly different from the previous problem where it said that 975 rupees was received in full settlement. But here it says 975 was received from Shyam on his account. On his account means it is not full settlement. 25 rupees is still receivable from Shyam. So Shyam is the giver, so we will credit Shyam with 975 and we will debit cash with 975. So the accounting entry to record this transaction is cash account debit to Shyam 975. 25 rupees will be the balance in Shyam's account, which is receivable by the business later. Right. Outstanding salary account is a representative personal account because it represents the amount that is due to employees. So it is a representative personal account. Patents account. Patents account is an intangible asset. It's an intangible asset. Software companies have patents. Pharmaceutical companies have patents. So these are intangible assets which are generated by their research and development processes. And so it is an asset account. Personal income tax account. In case of a sole proprietor, a personal income tax account is drawings, which means it represents drawings of cash from the business in order to pay the personal income tax of the proprietor. So personal income tax account that is an account that represents the personal transactions of the proprietor. So it represents a person, it represents the proprietor. So it is a representative personal account. Prepaid salary account is represents the salary that has been paid in advance to the employees, and hence it is a representative personal account. Prepaid salary account is a personal account. Proprietor's account represents the amount that is either receivable from the proprietor or it is payable to the proprietor by the business. So it is a personal account. Right. Provision for depreciation account. See, this is a tricky question because we would not know whether it is to be treated as an expense or to be treated as a liability, because this is the general confusion, whether to treat it as an expense or to treat it as a liability. See, depreciation is an expense. When a provision for depreciation is created, we debit depreciation because it is a nominal account, it is an expense. The rule is debit all expenses, and so we debit depreciation account. And we are creating a provision for depreciation which is in the nature of an appropriation of profit. And so the accounting entry when we create a provision for depreciation is depreciation account debit to provision for depreciation. Right? Which means provision for depreciation has a credit balance. All liabilities have credit balance. But does it mean that provision for depreciation is a liability? We have to go back to the definition of a liability. A liability is a present obligation, the settlement of which will result in cash outflow or outflow of future economic benefits to the business. Provision for depreciation is not going to result in any future cash outflow or outflow of any economic benefit. So strictly speaking, it cannot be called a liability. Then what is it? We can say that it is a negative asset. So broadly, it is an asset account. Next, provision for discount on debtors. The logic is the same. That is, logic of treating provision for discount on debtors account as an asset account is the same as we treated provision for depreciation as an asset. See, provision for discount on debtors is a provision that you are making for the discount that you will have to pay or the discount that you will have to extend in future when debtors are going to settle you promptly. So, discount, the entry for making a provision for discount on debtors is discount on debtors account debit because it is an expense, it is a nominal account, we have to debit all expenses. So we debit discount on debtors account and we credit provision for discount on debtors account, which is shown as a deduction from our gross debtors in the balance sheet. And hence, this does not qualify as a liability, it is a negative asset, and hence we can broadly classify it as an asset. Provision for doubtful debts, applying the same analogy, it is also an asset account. Purchases account is an expense account because purchase is purchase of goods that are to be consumed in the manufacturing process or goods that are to be used for sale, right, that are held for sale. And so since sales is income, so whatever you purchase to either consume and produce goods for sales or what you purchase for immediate resale will be an expense. So purchases account is an expense account. Right. Purchase returns. Purchase returns means we purchase goods, we feel that it has not met our standard specifications, or if we feel that the goods are defective, the business returns the goods to its supplier. So when we debit purchases, we credit purchase returns. So does it mean that purchase returns becomes an income? No, it is, we can say it is a negative expense. So again, we'll classify purchase returns as an expense account. Yeah. Ram paid 900 rupees towards a debt of 950, which was written off as bad in the previous year. Okay. So here it means that the business had written off 950 rupees which was due to it from Ram. So the entry that it would have passed when it wrote off this 950 rupees would have been bad debts account debit to Ram, because bad debts is an expense. We have to debit all expenses, and Ram, we are not going to receive anything from Ram, and hence we are going to credit him. So entry is bad debts account debit to Ram. But during the current year, Ram has paid 900 rupees. So a debt which was earlier written off as bad has been recovered now. Cash has come in. So the cash is a real asset. So debit what comes in. So cash account debit 900, and bad debts recovered account is an income to the business, and we will credit the account called bad debts recovered account. So the entry for this transaction is cash account debit 900 to bad debts recovered account. So the answer is none of these. Here, Ram's capital account is a representative personal account. Ram's drawings account is a representative personal account. Ram's account is a natural personal account. Next, question number 64. Received a first and final dividend of 60 paise in the rupee from the official receiver of Mr. Rajan, who owed us 1000 rupees. So Mr. Rajan has owed the business 1000 rupees. He has become insolvent. He has become bankrupt. And hence there is an official receiver who has been appointed to settle all his creditors and all his dues. And in that process, the business has received 60 paisa in the rupee, which means it has received 60% of 1000 rupees. So the entry is cash of 600 rupees has been received. So debit cash 600 rupees. 400 rupees is irrecoverable. It is a bad debt. So bad debt account has to be debited with 400 rupees, and nothing can be recovered from Rajan. So his account has to be closed. His account had an opening balance of 1000 rupees. Now nothing is receivable from him, and so his account will be credited with 1000 rupees. So the accounting entry to record this transaction is cash account debit 600 rupees, bad debts account debit 400 rupees, to Rajan account 1000 rupees. So the entry is, the option is D. Question number 65. Rent paid to Ram, a landlord, should be debited to. Okay. So rent is an expense, and all expenses have to be debited. So rent paid to Ram should be debited to rent account and credited to cash account. Answer is A. Yeah. Reserve for discount on creditors. So suppose you are expecting creditors to give you a discount when you make a settlement, when you settle the creditors. A reserve is created for this. This does not make it an asset account. It is still a negative liability. So it will be broadly classified as a liability. Salary account is a nominal account. Salary is an expense, and hence all expenses and incomes are nominal accounts. So answer is C. Next, salary payable to Shyam. So we saw that salary is an expense, but salary payable is a liability, right? And salary payable to Shyam account is an account that shows how much money is payable to Shyam, and hence it is a representative personal account. Sales means sales of goods in which the business normally deals in. It is sale of, let's say there is a retailer or there is a person who sells stationery goods. So he would account for sale of books, or sale of paper, or sale of markers as his sales. Right? Suppose he sells off his computer, that will not be a sale. That will not be accounted for as sales. Okay? So sales is a sales account represents the sales, or rather the principal revenue generating business of or the revenue generating activity of the business. So it is a revenue account. Sales returns account is when you get back goods that you have sold. So it doesn't. So while we credit sales, we debit sales returns, but that does not make it an expense. It is some sort of a negative income, and hence it would broadly be classified as a revenue account. Sales tax payable is a liability. It represents the amount that is to be payable to the sales tax authorities, and hence it is a representative personal account. Technical know-how is an intangible asset, and so it is an asset account. The balance of an account is always known by the side which is read. See, debtors have debit balances, creditors have credit balances. Why? Because if you look at the account, if you look at the debtors account, the debit side is higher than the credit side, always higher than the credit side. The debit side of the debtors account records the opening balances of debtors, the credit sales made during the period. The credit side shows how much sales have been made, or sorry, how much cash has been collected from debtors during the period. And so the closing balance will be the difference between the debit side and the credit side. And the balance of an account is always known by the side which is higher. The debit side, in case of a debtor's account, would be higher than the credit side in normal cases, right? And so it has a debit balance. A creditor's account, the credit side will be higher than the debit side, and so the balance of an account, balance of the creditor's account, is called the credit balance. The process of recording a transaction in the journal is called journalizing. The process of transferring the transactions relating to changes in a particular item at one place in the form of an account is called. Okay. So after journalizing, journalizing is where you have a journal where all transactions are journalized, that is journal entries, the debit and the credit aspect of every transaction is journalized, after which all these journal entries are posted. These journal entries are posted in various accounts in the ledger. So an account is a place where transactions relating to a particular item are recorded. For example, the business has sold goods to Ram. The business has sold goods to Shyam. Business has sold goods to Ravi. So the sales made to Ram will be recorded in a separate account called Ram account. Sales, I'm assuming that all these sales are for credit. Okay. Sales made to Shyam, all the sales made to Shyam will be recorded in a separate account called Shyam account. Sales made to Ravi, all these sales made to Ravi will be recorded in a separate account called Ravi account. Okay, so an account is a place where transactions relating to a particular item are recorded, and the process of making an entry in various accounts from the journal is called posting. The return of goods by a customer should be debited too. Return of goods means it is sales returns, which is otherwise called return inward. So it is coming in. The goods that were sold are coming in. So it is return inward. And when we make a sale, we credit the sales. But when there is a sales returns, we have to debit sales returns, otherwise called the returns inward account. The words to balance brought forward or by balance brought forward are recorded in the particulars column at the time of posting and opening entry. That is, when we open, suppose we are opening the debtor's account, then the closing balance of the previous year would have appeared in the previous year's ledger account as by balance carried down. That will be brought forward to the current year as to balance brought down. In case of creditors, it would have appeared in the previous year as to balance carried down, and that will be brought forward in the current year as by balance brought down. So these words are used in order to recognize or in order to record the opening balances of various assets, liabilities, and capital. The words to balance brought forward or by balance brought forward are recorded in the particulars column at the time of carrying forward. That is, we are bringing down the balances or we are carrying forward the balances to the future years. So we use the words when we are carrying forward balances. Trademarks is an intangible asset, and so it is an asset account. Unaccrued interest. Okay, unaccrued interest is interest which is not yet accrued, and it represents a person from whom interest is to be received. So it is a representative personal account. Which one of the following is correct? Credit means decrease in liability and an increase in asset. Debit means decrease in asset. Credit means increase in asset. None of these. According to the accounting equation approach, right, all assets, all increase in assets have to be debited, all increase in liabilities have to be credited. Whenever an asset decreases, it has to be credited, and whenever a liability decreases, it has to be debited. Right? See, one example is, let us say a machinery is being purchased for cash. So one asset comes in, one asset goes out. Machinery comes in, so there is an increase in the machinery balance, so we will debit machinery. Cash goes out, there is a decrease in assets, so we will credit cash. So the accounting entry is machinery account debit to cash. So none of this. Credit means a decrease in liability is wrong, because whenever a liability increases, it is credited. So whenever a liability decreases, it is debited. That is, when we settle our creditors, what do? We debit creditors. Why? Because we are settling our creditors, our liability comes down. So a decrease in liability is debited. So answer is none of these. 82. While balancing an account, the balance of an account is recorded on the side which is shorter, because one side is, let's say we are looking at the debtors account. The closing balance of debtors will normally appear on the credit side, because the credit side is shorter than the debit side. The debit side is heavier than the credit side, and hence the balance will be on the credit side of the account. Withdrawal of cash for personal use should be debited to drawings account. That is, drawings account represents transactions wherein the proprietor has either withdrawn cash or has withdrawn goods from the business for his personal use. So when he withdraws cash, drawings account has to be debited and cash goes out. So we have to credit cash. Withdrawal of cash from bank for personal use should be credited to the bank account. Drawings account will be debited and bank account will be credited. Withdrawal of cash from bank. So here cash is involved and bank is involved. Cash is a real account, bank is a personal account. So cash comes in, so debit what comes in. So we'll debit cash and credit the giver. Bank is giving us cash, so we will credit bank. So we will debit cash and credit bank. Answer is A. Yeah, so with that we complete all the questions in this review session. So in case you have doubts, please feel free to mail me at queries@gmamatteracademics.com. Sorry, I repeat the mailing address again. It is queries@greymatteracademics.com. So until next time, bye.